Okay, traders, welcome back to episode 19. So in this episode, I'm going to cover some vital things following trade management. So your entry, how your idle, by now you understand our idle entry point, but now we're going to go into when and how to remove risk, when you can put your stop loss into profit, and how to compound, meaning adding additional positions to an existing trade, how to trail those positions to also remove risk, and when to effectively exit. So I'm going to show you US dollar CAD as an example because this is actually every single thing in one once you understand how to look at it. So when we have US dollar CAD here, I'm going to leave it all on. So we've got our A to B, so you understand that concept by now. So we understand that our A to B, we're looking for a 66% entry. So I'm going to leave all the risk and rewards on so you can understand. So 66% entry here. Our stop loss is initially 289 pips. And at minimum, as you guys understand now, we're looking for this to be dragged on. So from our entry where we're looking for at least price to come up into this target here, which would now give us a 2.75. So obviously we're using a weekly chart. This is the exact same on any time frame, daily, 4 hour, 1 hour, 15-minute. I don't care what time frame it is. Market structure all moves the same. So that's your first entry point now. Depending on how you want to go with the trade. So if you are more of a trader who doesn't really like to get involved in the trades, then you don't need to do anything. If you're a trader that for you now you want to actively get involved in the trade, then you need to understand you need to wait for price to make a higher low. So it needs to make a new high like you just seen here and then make a higher low. Again, our entry point is at the 66. That's our potential target, and our stop loss is almost identical. So what we can do now, so we've got two trades simultaneously running. Yeah, so we've seen price go all the way up here, pull back. At this point, when we've seen price start to break down, so this is the crucial area here. So when we've seen price start to break through that region here, what you now need to do is just remove your risk, just break even. Don't put anything into profit yet. Remove your risk. So now you have no risk on this trade. You still have an exposed risk of 1% on this trade. So what can we do now? Once price gets back above that zone, so this was the zone that made you move this into profit, break even, sorry. Once price now trades above this level and we see price continue up and we've made that new high, what can we do now? So let's have a look at our fib again. So A, B. So now again, we're entering at 66. So we're just doing the same thing over and over and over. So we entered at 66 right here. Stop loss is almost at the same place right there. So what you're noticing is you can now, you're always one move behind. So now you've entered here. Price has now gone on and made a new high. What you can do with this is remove your risk. What you can do with this trade now is, I'm going to put this in green as well, is now move this trade into profit. So this trade now has been moved into profit. So you're in profit of around 190 pips. This trade now, it has no risk. So you've already banked positions. You've banked guaranteed profits being made here. No risk here. You still got exposed risk here. Then now what do we see? At this level here, A, B, C, we would have gone long again at 66 and we would be what? Targeting a new high. So this is where you understand that we've gone into how to enter, how to remove risk. So now we can remove our risk on this trade. We've got no risk attached to this trade now. What can we do with this stop loss? This stop loss now can get moved to here, which is 235 pips. This stop loss now can get moved to here, which is 427 pips. So now we've seen this trade's in profit, this trade's in profit. This trade is risk free, this trade still has risk attached to it. So when we're looking at price now, we're seeing, building on from what we went on before, earlier episodes of CAS that you should remember, we now failed to make a new high. So what this shows to me now is we have to get ready for the possibility of price now reversing. So if I just map this out, so you can see low, high, low, high, low, high, low, high, low, no high. So that's the red flag. So we've come up and made a lower high. So that is a red flag. So I'm going to leave. That's what we should be saying, should be seeing. So I'm going to leave this to what it's done. So which is going to put that in red now. This is going to be put in red. So you to understand. Hold on 1 second. Let's go back to this. Put this in red. So now what we're seeing is price has come up, lower high, lower low. So essentially now for me, I'm going to explain what you need to do. This trade here, the moment where we broke structure. So at that moment right there, just to be very clear, so this is a warning of when to exit a trade. So even though we've made a lower high, we might just see price consolidate again and then rally straight back up. It's not always that price, if it makes a lower high, it will not continue. It's just the probability is in the fact that possibly we're going to look for further downside. But as soon as price has now broken out here with that such a strong candle, and you're going to understand based off everything I've been showing you over this video series, that we're now looking at structure has now shifted on a daily time frame, but this is more of a daily trade. So you understand a big pullback is coming, even if it's back down to 1.32 or even if it's back down to take you out. So at that point, this candle has broken down and closed here. You now need to remove your risk. You need to remove your risk. With your previous trades, what you need to do is they need to get moved up. So now you're in 500 pips profit, and this trade now is in 720 pips profit. So you have no risk attached to this outcome. None. If you're an experienced trader, you can hedge. So hedging means now you could have been looking for a short position. So you could be looking for a short position with your stop obviously above here, while you've still got your long trades running. But at the moment now, price has crossed over this area here. The moment price crossed that area there, that was your red flag. That was your red flag that this trend has potentially started to reverse, and you're seeing this here now start to reverse. And now what you see, lower high getting made. We're now seeming like we should be going to make a lower low, which for me has come in now here, but we've got a higher low there. Like I said, pulled back up, lower high created, another lower low. So we might see this, but what you're understanding is price is now changed in terms of structure. So you understood how to enter. So our entries are coming from our C leg reversals. Our stop loss is in validation below our A leg. How you remove risk is once price has created a new high, you can remove risk. Once price creates a higher low and continues, you can put your stop into profit at the bottom of that now higher low. And you continue to do so as price trends in your favor. The red flag of where to exit. So once you've had your additional compounded entries, if that price structure keeps repeating, where you exit now is when structure changes and you see a lower high come in, and it makes as soon as a lower high forms, now you have to put everything up as far as it can go, because you don't want to lose the majority of the trade. It's all about protecting capital, and that is the most important lesson when it comes to trade management and anything to do with managing trades. So even for example, I'll show you another example on a daily time frame with euro dollar. So even with euro dollar here, same exact thing again. We're looking at shorts. We're looking at shorts. So we've got into the market. Here when we've seen price obviously break out. So I'm just keeping it here. We've got into the market here. Price has broke out, retested structure. So now we're short here. Stop loss above that high for me because that's a wick. You could put your stop loss above here to be obviously out of all the noise, but for me that's fair enough. and you're obviously looking for a new low. So that trade there is in full effect. Yeah, price now drops back down, comes up. So if you moved your stop loss, you potentially into profit, you potentially would have got stopped out. That's what I'm trying to show you. So price drops down again. Let's get our ABC. Price drops down, ABC. We're entering at 61.8. So I'm not giving us perfect entries because we have to be realistic. So we're entering around 61.8. So we're entering around here. So our stop loss now is here. Our take profit is now here. So let's just keep this going. So now we've made a lower high. What can we do with this stop loss? We can move that stop loss down. We can't do anything here yet. And perfect example of what I've just said. Price here created a higher low. You see that? Higher low has come in. We dropped, higher low came in. So we can't move nothing here. What I would do is just break even, because that's a red flag. I'd break even because that's a red flag. I don't want to see higher lows getting made. What would I do with this entry? I'd now move it down. So I've locked in 73 pips. Price drops back again. We wouldn't have had an entry there. So we're looking for our ABC again. What do we see? We get a lovely 61.8. Perfect entry again for us right here. Stop loss is now where? There. Target is now down here. Perfect. What can we do now? What can we do now? So this trade here, that stop can come down to our other stop of 100 and something pips now. This trade now can come down into 36 pips. And now we're watching the trade rally down. We've got this area of support and resistance right here. So like I said, support, fell to close. Yeah, so you need to be aware of that area. As we pull back up, we've broken through this area. So price now shouldn't get back above. So this trade now can do what? We can break even. This trade now, we can move down into profit. This trade now, we can move down into profit. Price now comes all the way back up because now structure is broken. We shouldn't get back above this level. That's our red flag, but we could still just react from one and go lower, which is why we haven't closed. Let price do what it does. Price breaks out. We get a breakout. We get a retest here, which we shouldn't see. That's your red flag to close the trades. But again, let price play. Price comes up, stops you out now. So all of our positions would be stopped out. But now we've banked nearly 100. We banked 193 pips here, 116 pips here, and this trade merely got broken even. With this position here, another thing you could do is once you do see something happen, like we've seen here, price has now done price action that we shouldn't see. We've broken back above the support resistance. You could close out majority of this trade. So this trade here, if you see invalidation or you see something you shouldn't see, just close out 80%. Close out 80% of the trade, just to be sure. Just so every position is a winner. So once price broke back through here, got above this yellow zone, that's your trigger. Close out 80%. So all you've done now is just get broken even. So you've lost that 20%, but it's a good thing. Otherwise, you would have given back the majority of the trade. So like I said, I've used higher time frames just because it's more clearer. But this happens on any time frame, and it's going to follow the same rules if you're using our trading strategy. So hope you enjoyed this episode and stay tuned for the next one.